Welcome back to the boardroom. Between 2023 and 2026, the technology shifted definitively from generative artificial intelligence, which focuses on producing text, to agentic artificial intelligence, designed to independently formulate plans and execute workflows across disparate enterprise systems. This evolution fundamentally alters the enterprise risk profile of commercial and retail banking. We are no longer dealing with large language models that simply give incorrect answers. Autonomous agents introduce the profoundly more severe risk of executing irreversible, harmful actions at machine speed. Today, we must attack the greatest compliance illusion in modern banking, the human in the loop. Look at the catastrophic collapse of Zillow offers. In 2021, Zillow announced a $304 million write-down of housing inventory and shuttered its algorithmic home buying division. Zillow operated at level 2 autonomy. Algorithms priced thousands of homes while humans approved the final bids. But that override mechanism lacked structural independence. When the algorithm failed to detect market drift, the human operators did not stop the machine. Instead, they amplified the error by approving overvalued bids, acting on institutional momentum rather than objective risk assessment. Most banks deploy a human reviewer at the end of the workflow and assume safety follows. The data proves otherwise. When a model drifts, leaders should stop it, not fund its momentum. Human review fails when reviewers share the AI's bias or are buried by volume. An override is a real control only if it's structurally independent of the outcome it governs, not just a button. If legacy human oversight is broken, how do we safely deploy agentic architecture? First, we must stop confusing regulatory definitions with operational boundaries. Many believe materiality and customer impact dictate autonomy. They do not. Materiality and customer impact simply dictate whether a model falls under strict governance regimes, such as the Federal Reserve's SR 26-2 or the European Union AI Act. They dictate whether a system must be tightly governed. In contrast, reversibility is the operational constraint that dictates exactly how a bank can safely permit an AI to act autonomously within the confines of those regulations. Second, we must confront the reality of the multi-agent network. When multiple specialized AI agents interact to complete a complex workflow, an erroneous output from one agent can easily cascade as a poison input to another, creating rapid multi-agent error propagation. If a level 3 data retrieval agent hallucinates a critical financial metric, the industry lacks standardized frameworks to definitively prevent a level 2 execution agent from blindly acting upon that poisoned data. Third, we must shatter the black box excuse. The United States Consumer Financial Protection Bureau has explicitly mandated that creditors utilizing complex algorithmic models must still provide applicants with specific principal reasons for any credit denial. The Bureau firmly declared that algorithmic complexity or black box opacity is not a valid legal defense for failing to provide accurate, comprehensible consumer notices. Claiming algorithmic sophistication without rigorous, transparent operational reality is no longer legally defensible. To operate defensibly, chaos must snap into mathematical architecture. Executives must evaluate every proposed workflow against 3 rigorous axes, the 3 gates it must pass: reversibility, containment, and audit trail. Axis 1, reversibility. This measures the systemic and financial friction required to completely unwind an artificial intelligence's action. High reversibility workflows, like drafting an internal credit underwriting memo, have no permanent external consequence until a human formally approves it. Conversely, executing a real-time cross-border wire transfer has extremely low reversibility, triggering immediate legal and financial irrevocability. Axis 2, containment. This evaluates the potential for cascading operational failures within a multi-agent environment. Defensible containment requires cybersecurity teams to implement kill switch procedures, application programming interface allow lists, and prompt injection protections that sever an agent's connections during an active incident. Axis 3. The audit trail. Because an agent acts as a digital worker, you cannot simply ask what numerical output the model produced. Your institution must maintain immutable audit logs, where every prompt, user input, retrieved data point, and human override is cryptographically hashed and recorded. Furthermore, your architecture must include a dedicated explainability layer that generates transparent chain-of-thought reasoning and brief, human-readable summaries explaining why the model arrived at a specific conclusion. Without these components firmly established, any autonomous operation above Level 1 remains legally indefensible. The technological evolution from artificial intelligence that merely advises to agentic AI that autonomously acts represents a fundamental, irreversible expansion of enterprise operational risk. The moment a model stops recommending and starts executing, the failure surface changes shape entirely. Let us be absolutely clear. Your organizational capacity to safely deploy autonomous artificial intelligence at scale is gated not by the raw computational sophistication or speed of the underlying algorithms, but entirely by the rigorous, uncompromising maturity of your bank's internal controls. I will leave the chief financial officers and chief risk officers with one undeniable truth. The legal and financial liability for an artificial intelligence's action rests entirely, immutably on the deploying institution itself. A bank cannot, under any circumstances, abdicate its legal responsibility by citing third-party vendor software errors, nor can it defend itself to regulators by claiming that the artificial intelligence operated as an opaque, incomprehensible black box. The accountability does not transfer, it never leaves your balance sheet. Attempting to bypass Level 2. Supervised autonomy for any material financial decision without establishing ironclad, structurally independent human oversight is not just a strategic misstep, it is currently a direct, indefensible violation of global compliance mandates. Independence here is structural, not cosmetic. The human check must sit outside the outcome it governs, not beside it, and never answer to the team that owns the result. The most successful banking institutions over the next 3 years will not necessarily be those possessing the absolute smartest or fastest models. Rather, the market will belong to those that proactively engineer the most structurally resilient, aggressively governed, and immutably logged autonomy architectures. The winners will treat governance as a design discipline, built in from the first line of code, and will prove on demand exactly which agent did what, when, and under whose authority. I am the AI business architect, designed to subscribe now.